What is going on, my friends? Ryan Williams here, back with another one, and in today's video we are going to be talking about the best dividend stocks to buy in October of 2021. And in this one we'll be covering not one, not two, not even three, but 5 different dividend paying companies that look like good buys for the month of October. And just so you guys know my criteria, I chose these 5 specific stocks based on how they're currently valued, how they've been performing lately, and yes, absolutely because of each of these stocks' dividend stats, which, as you guys know, is what I love most about dividend stock investing. There is just nothing better than getting that dividend income. Anyway, before we get rocking and rolling, if you are stoked to learn about some dividend stock discounts today, go ahead and give this video a big thumbs up. And if dividend stocks is something that you're interested in or maybe even passionate about, I would ask you to consider subscribing to my channel. On my channel here, we strictly talk about dividend stocks, nothing else. And at this point, guys, I'm putting out 2 videos every single week, one on Wednesdays and one on Sundays. So there's a lot of great dividend stock content coming your way. And I would love to have each and every one of you along for my dividend investing journey. Anyway, enough rambling on my part. Thank you guys so much for doing that. I really appreciate it. And now, without further ado, let's get into it. All right, guys, now the very first stock I want to talk about today is none other than Bristol Myers Squibb, ticker symbol BMY. Now, if we look at this price performance chart, guys, and we switch over to 1 month, we can see that just in the last 30 days, BMY is down over 12%, which is a very substantial drop in share price, if I do say so myself. I'm sure most of you guys would agree out there. But this is good for us dividend investors because we can pick up a great dividend paying company for, you know, a little 12% discount or 12% cheaper than we could 30 days ago. And then if we look at the right-hand side of the screen here, we can see that as far as the PE ratio goes, it's looking pretty affordable too. PE ratio currently sitting at 8.11, which is very cheap. And I think we can attribute this lacking performance and substantial drop in share price just to some recent news that came out about this company, which we'll touch on more in just a moment. But for now, let's switch over to the dividend scorecard page and just see what the dividend is looking like for this company. So scrolling down here, guys, we can see that BMY has a pretty solid yield, 3.23%, and a payout ratio that's looking pretty low with some room to grow, sitting just above 26%. A 5-year growth rate that's also a little bit on the lower end, guys, just under 5%, 4.92 to be exact. And then a dividend growth history of 14 consecutive years, which is really not too shabby. Let's go over to this dividend history page. Okay, this is what I wanted to look at here. So with 14 years of consecutive dividend growth, it looks like they've been just paying their dividend for over 30 years, 31 years, which is a pretty solid dividend payment history. And if we zoom out here, let's zoom out to the max. Okay, yeah, we can see a pretty good upward slope here. It looks like from about, 2001 to about 2007, the dividend growth was looking pretty non-existent. And then they picked it back up in 2008 here, and it looks like they've been growing it pretty steadily ever since then. So it's good to see somewhat of a dividend growth history with this company. And it's also good to see, even despite some years of not growing, still consistent payments. I like to see that. And then touching on some of the news that has come out surrounding this company that may be, you know, the catalyst for the drop in share price. There's a couple things we're talking about. So first of all, BMY's drop in share price can somewhat be attributed to the recent news that came out about the Biden administration's plans to reduce healthcare costs and make drug prices cheaper, which is something that we covered in one of my recent videos where we were talking about Johnson & Johnson, which that and some other healthcare stocks were affected by this news as well. And if you guys want to check out that video, I will include a link to it in the description of this video. Outside of this, though, a recent Forbes article tells us another reason that BMY might be seeing such a big drop in share price. And that article reads, BMY's performance is largely in line with the big pharmaceutical stocks, except for PFE, which is Pfizer, which has outperformed both its peers and the S&P 500, owing to its COVID-19 vaccine sales. Pharmaceutical companies are impacted by the current pandemic, which has resulted in lower sales for drugs. That said, the sales have begun to rebound over the recent quarters. In fact, the company's second quarter results were better than the street estimates. But now, given the recent decline, will BMY stock continue its downward trajectory over the coming weeks, or is a recovery in the stock imminent? Now, personally, guys, I think a recovery with this stock is imminent. I mean, despite this recent news, it's still a good company. Still growing. If we scroll down, actually, look at this revenue chart right here. It pretty much does nothing but go up in revenue. And from 2019 to 2020, huge jump in revenue. 2020 going into 2021, okay, they're estimating another, looks like probably a 10% revenue growth right here just between these years. And then even going into 2022, it looks like 5% growth or something like that there, maybe a little bit over 5%. So this company is still growing and doing more sales than it did the previous years, which is something that we like to see. And I think the share price will come back up. We just have to let the wave of this recent news surrounding this company pass. And just so you guys know, this is not a stock that I have in my own portfolio. I actually don't have any plans to purchase this stock, but that doesn't mean it's not a good company to own, not a good company to buy. I know a lot of other dividend investors have this one. And just as far as the dividend goes, from what we saw, it looks like it's paying a pretty reliable and sustainable dividend. Especially you combine that low payout ratio with the years of growth. It looks like the dividend's in good hands. All right, guys, moving on to stock number 2, another one in the pharmaceutical sector. We have AbbVie, ticker symbol ABBV, which is a stock that I do have in my own portfolio, and I'm very pumped to talk about it. So as you guys can see right here, in the last year, it has grown about 23% in share price. But if we switch over to this 1 month performance, it's really come down, okay? A 10% drop just in the last 30 days, and a PE ratio that looks just about as low as what we saw with BMY, currently sitting at 8.51. Now, one of the differences between this company right here and BMY is the dividend. So if we go over to the dividend scorecard page, we can see that AbbVie has a bit of a higher yield than what we saw with BMY, with their forward dividend yield sitting at 4.84%. And with that comes a payout ratio that's a little bit higher as well, but still not too bad, 41.24%. I'm sure you guys have heard me say this before if you've seen my videos, but kind of the range that I really look for is, well, really just below like 60%, okay? And then moving on, AbbVie also has quite a bit of a higher 5-year growth rate, currently sitting at 18.01%, which is very high, and then a dividend growth history of 8 consecutive years. But let's jump over to the dividend history page, and okay, we can see that the years of growth and the years of payment both match 8 years. So that's not as long of a growth or payment history as BMY, but still, not going to knock AbbVie. It's a great company, at least from my experience. It's done pretty well for me. My current position in this stock is actually down, I think about 5%. I recently bought into some this week, actually. I think this stock will rebound personally. So, if it's down 10% right now, I might as well pick up a couple shares. I think I picked up a share and a half. Lowered my average cost per share a little bit, which is nice. But scrolling down, guys, let's just take a look at the sales of this company real quick. Okay, and we see a pretty decent revenue growth slope here. So 2019 to 2020, once again, huge jump. Okay, an extra $12 billion in revenue going from 2020 to 2021. That's also really big, going from 45 to 56, $11 billion jump, and then estimated 2021 to 2022. Okay, not as big of a jump, but they're still growing. And then let's look at this, let's look at the growth page real quick. I wanna take a look at okay, so we already knew that the revenue was growing. We just saw that from the chart on the previous page. But this other piece right here, the levered free cash flow, also seems to be in a really good spot. Year over year, it's grown almost 50%, which is huge. Okay, across the last 3 years, compounded 25%, across the last 5 years, 17.5%. That's a pretty good growth in levered free cash flow. That is something I like to see. And this also speaks to what could happen with the dividend. So if they're continuing to grow in levered free cash flow like this, I think it's safe to assume that they're going to continue to grow the dividend. If nothing else, at least pay the dividend. But I would imagine they'd keep that growth. Hopefully keep that 18% dividend growth growing if their levered free cash flow is jumping up this much every single year, 3 years or 5 years, whatever. But then going back to the summary page, guys, what is making this stock go down 10% in such a short amount of time? I think the same news surrounding healthcare costs that we talked about with BMY also holds true here for AbbVie, but there's also some news that involves the FDA that could be affecting the share price as well. So an article from Yahoo Finance that I found reads, "It is no secret that regulators make or break the markets, but few sectors are under their power as much as the pharmaceuticals. A recent decision by the FDA had a severe negative impact on the share price," talking about AbbVie's share price. The FDA added new and updated warning on drugs, including Rinvoq, how do you pronounce that AbbVie markets. Multiple analysts, including those from JP Morgan and Citi, called this move exaggerated, yet the stock doesn't show signs of bottoming just yet, which means, guys, it could still continue to go down. Now, meanwhile, BTL Industries announced a resolution in the patent infringement claims against AbbVie related to their muscle stimulation technology. Per the agreement, AbbVie will pay an undisclosed sum, and all litigation pending between the parties will be dismissed. All right, guys, so there's a couple things going on in this article here. In the very first paragraph, it mentioned a new warning label that will be added on some of the drugs that AbbVie markets, or at least one, that Rinvoq, I don't know how you pronounce that. Some of these pharmaceuticals just have some weird names, guys. And then jumping over to that third paragraph, it looks like AbbVie is now settling in a patent infringement suit and will have to pay what it says is an undisclosed sum. which kind of sucks. They have to shell out money for that. But then again, guys, AbbVie is making so much money right now. If we go back over to the screen here and scroll down, I mean, let's look at actually their financials page. Just in the trailing 12 months, they've done over $36.6 billion in gross, just gross profit, okay? $53.7 billion in revenue so far in the trailing 12 months, but $36 billion in profit. I'm sure they're gonna have enough to cover whatever that undisclosed sum is and still be fine. So with that said, guys, I would take this news as just a temporary hit in the share price. It may bottom out a little bit more, as the article said. At least in the shorter term, it's hard to predict what's gonna happen 10, 20 years out, but at least in the shorter term, I think we'll see AbbVie recover and go back up in share price. So at least in my opinion, like I said, I'm buying AbbVie right now. I think it's a good time to buy this stock. I mean, you might as well pick up some shares while it's, down 10%. And don't forget the PE ratio is super low too, 8.5. So that's, a very low PE ratio. All right, guys, moving on to stock number 3, we have Verizon, ticker symbol VZ. And across the board, the share price of Verizon really doesn't seem to be doing too well. In the last year, it's down 7.6%. In the last 6 months, it's down about 4.4%. In the last month, it's down to 1.8%. And even just in the last week, it's down just a little bit, just a hair. So as of late, at least in the last year, guys, this stock has done nothing but go down in share price, which as the days go on creates a better and better and better buying opportunity for us dividend investors, which is why I think going into October, this could be a good stock to stock up on. I actually did not plan to say that. I'm not even joking. And I will never say that again, I promise. I won't do that to you guys. But anyway, the point I'm trying to make is, guys, this stock looks pretty affordable right now. And if this continued drop in share price doesn't prove it, this PE ratio certainly alludes to it as well. 10.3 is the PE ratio, which is the highest we've seen all day, but in the grand scheme of things is actually a very low PE ratio still. So it indicates some affordability here for this stock. And then if we jump over to this value page, scroll down a little bit, let's take a look at a couple other metrics that could point to affordability for this stock. Number one being the forward price to book, okay, sitting at 2.82, trailing 12 months, it's 3.06, but it is continuing to come down. And then price to cash flow, guys, trailing 12 months and forward price to cash flow look the same, 5.83. Single digits, looking like a good price to cash flow, looks pretty affordable there. So you're gonna get some good bang for your buck with this stock right here. Now, scrolling up, before we get to the dividend, I wanna look at one more thing for Verizon. Let's take a look at the revenue growth and the free cash flow and see how that's doing. So if we scroll down and look here, honestly, guys, the revenue growth is positive, it is growing, but it's really not growing that fast, okay? Really not growing that fast at all. Across the last 10 years, compounded 2%. Across the last 5 years, compounded not even 0.5%. Okay, across the last 3 years, not even compounded 1% growth. And then year over year, 2.5%. That's really not a lot of revenue growth, guys. And then let's look at one more thing. Let's jump over to the financials page. Take a look at the free cash flow and see what that is looking like across time. So switch over to the cash flow statement, scrolling on down. Okay, we've got the levered free cash flow right here. And for the most part, it looks like it does go up. At least, in the last 5 years it has. So it's gone from December 2020, 16 billion to December 2016. So 4 years, it's jumped about almost $10 billion in free cash flow. But in the last 12 months, the free cash flow is quite negative. So negative that it's almost 2 times the amount of levered free cash flow that they gained in 2020. Hopefully this is like a one-off thing, but if Verizon continues to do negative free cash flow, negative levered free cash flow, that really does not bode well for the dividend, because that is what they use to pay the dividend. So if they're negative in free cash flow, eventually they're gonna run out of cash, which means they won't be able to pay the dividend to us, which is not good. So keep an eye out on the levered free cash flow, guys. But overall, in general, guys, Verizon looks like a good stock that's at a discount. And as far as communication stocks in general goes, guys, Verizon does seem to be the fan favorite over AT&T, or at the very least does not seem as polarizing of an investment as AT&T. With AT&T, you either love it or you hate it, but to me, it seems like most people are at least lukewarm about Verizon, even if they're not actually invested in it, which I am personally. I have both AT&T and Verizon. But in closing for this stock, guys, keep an eye on it, see what it does, okay? But it looks like it just continues to keep going down in share price, at least right now. All right, guys, now stock number 4 of the day, we have Best Buy, ticker symbol BBY. And I would imagine that most of you guys know what this company is, but I don't want to assume. So for those of you who don't, who've never heard of Best Buy, it's essentially a line of retail stores that sells technology or technological products, that kind of stuff, cameras, laptops, appliances, pretty much anything that has to do with technology, you go to Best Buy for it. But as it stands right now, Best Buy is another one that's looking to be at a discount and might be a good one to pick up. So in the last year, they're down just barely 0.3%. Year to date, they're actually up 6%, but in the last 6 months, this is where it starts to get really good. They're down over 10.5%, 10.64%. In the last month, they're down 5.34%. So the share price of Best Buy is coming down. 10% drop in 6 months is still pretty substantial, guys. And at its highest, it looks like it was at about 121 just, recently, but then going farther back in May, it touched 125. So there still is about $21 or so of upside potential, at least from its recent high of this 125.79. And then if we look over to this 52-week range here, we can see that it is moving closer towards the bottom. So where it's at right now may be a good entry point, although I'm sure some of you guys might want to hold out, see if it continues to go down, which it might, which, it could be a good one. Like Verizon, I think, actually, I didn't mention this, but could be a good one to dollar cost average into, just buy as the weeks go on. And then as far as affordability goes, guys, PE ratio 10.77, which is also very low. And a rule of thumb for you guys out there who maybe don't deal with this stuff a lot, a good kind of general number to stay under for the PE ratio for affordability, if this is the metric you're going to be using, is about 20. Okay, I've heard other people say I think Everything Money, which is a channel that I've been watching a lot of lately, actually, their rule of thumb is like 22 and a half. So anything under that is generally considered to be like affordable or kind of in the buying range. Everyone has their own rule of thumb or way that they like to do things, but hopefully me sharing this helps you guys a little bit. And now let's jump over to the dividend scorecard page and scroll down, guys, see what we're working with as far as the dividend goes. So forward dividend yield of 2.64%, which is, I think, the lowest we've seen today, right? Payout ratio that's also on the lower end, 28.4, but that's not a bad thing at all. 5-year growth rate, which is actually the highest that we've seen so far, 19.89%. It's just almost touching 20%. And then a dividend growth history of 8 consecutive years. And then let's see where the dividend payment history is. Okay, so they've been paying their dividend 9 more years than they've been growing it. 17 years of consecutive dividend payments. And just look at this growth slope right here, guys. Even between this and this right here, a jump of 15 cents per share. That's nice. And you know what? Before we move on to the next one, guys, leave me a comment below. What do you guys think about Best Buy? I feel like I go very back and forth on it in my head, just as far as consumer discretionary stocks goes. This is one of the ones that's sitting on my watch list. I also have Target and Lowe's on my watch list, and those kind of seem like the better investments to me. But let me know what you guys think in the comments below. I would be curious to hear your thoughts on this company. All right, my friends, now moving on to the 5th and final stock we are talking about today. That is Lockheed Martin, ticker symbol LMT. And I'm sure you guys aren't surprised that I included this one in today's video. If you've been watching some of my recent videos, I've been talking about this company quite a bit. But for those of you who are not familiar with some of my other videos, a quick tidbit about this company. This is the next stock I'm going to be adding to my portfolio. I'm really hyped on Lockheed Martin right now. And let's get into a little bit why, just as far as the dividend and affordability and stuff like that. So just in the last year, guys, Lockheed Martin is down 10%, okay, which is pretty nice, okay? It's coming down in share price. In the last 6 months, it's down 2.5%. In the last 1 month, it's down 3.7%. And then in the last 5 days, it's actually up, which is kind of surprising because it just seems like it does nothing but go down, which means I probably should pull the trigger and get into this stock soon. But anyway, guys, the gist of it is Lockheed Martin is looking pretty affordable right now. If we jump over to the 5-year, just the 5-year price performance, we can see that it is up across the last 5 years, which is good, okay? But as far as its upside and how far it could go, it looks like at its peak in the last 5 years, it was at $439.85, and that was February 2020, so right before the big dip. And then pretty shortly after this high, it just really went down to under $300 per share, which is pretty wild. But nonetheless, guys, it's currently sitting, we can see $348 right here. So it almost has $100 of upside potential to get back to where it was this February 11th mark, $434. So across time, it could get back up above that $400 per share, which would be good. That's a pretty big jump in share price. And then as far as affordability goes, guys, the PE ratio is currently sitting at 12.83, which is actually, this is the highest we've seen today as far as PE ratios go. But just remember that rule of thumb that we talked about moments ago. It's still considered affordable just if we're using that rule of thumb, below 20 or 22 and a half, whatever, theory you subscribe to. But scrolling down, let's look at the revenue, guys. It has a really steady revenue growth across time. It does nothing but go up consistently, which is definitely something we like to see, especially for long-term investments. We want them to continue to grow and expand and increase sales, especially if they're going to keep growing and paying the dividend, guys. Which brings us to the next point. Let's scroll up. Let's talk about the dividend for Lockheed Martin. So, okay, for dividend yield, 3.25%, not too shabby. Okay, a payout ratio right in the sweet spot, 41.74%. A 5-year growth rate that is also nice to see. It's not too high. It's not too low either, 9.52%. And then a dividend growth history of 2 years, which does not sound like a lot, guys. And it's really not. But if we go over to the dividend history page, we can see that they've still been paying their dividend for 26 years, except for this one little blip right here, which is 1 quarter where, for whatever reason, they did not pay the dividend, which is why they only have this 2 years of consecutive dividend growth. But otherwise, guys, except for this one little blip right here, they have maintained the growth of their dividend all the way back to, looks like 2003 right here. So I won't hold this one little thing against them. And otherwise, guys, this seems like a really good company to get into. And it's one that is historically pretty expensive, but like we've just kind of talked about, it looks like it's coming down in share price. And we'll see if this 5-day increase is a trend. I mean, if we look at this chart here, we can see it's kind of starting to pull back up just right there. So we'll see if that continues. But once again, this could be a good one to dollar cost average into. At least, guys, that is going to be my approach to Lockheed Martin LMT, which brings me to the next thing I want to talk about in this video. Since it's Sunday, let's switch over and give a little bit of a weekly portfolio update. And I want to talk to you guys about what I have going on in my portfolio and some of my upcoming plans, which includes this company right here. All right, guys, so what we are looking at is my dividend portfolio tracking spreadsheet that I have made using Google Sheets. If you guys want to grab this, there is a link to it in the description of this video. You guys can get it for free. Don't have to do anything. And then there's also a video walkthrough of how to get set up and start using this spreadsheet for yourselves, using all the stocks in your own portfolios and your positions and stuff like that. So definitely check that out. All right, guys, now let's get into the portfolio update portion of this video. So just in this week, guys, I actually picked up a couple different stocks. So usually I will contribute all of my weekly contribution to just one company. And lately that has been Intel. I've just been buying Intel like none other. I'm up to over 14 shares of Intel, which now it makes up, let me see here. Now Intel makes up almost 3% of my total portfolio, which is my goal. I want to get it to 3% before I move on to anything. But guys, one of the stocks we talked about today, AbbVie, was at such a good discount that I had to pick up some more AbbVie. So usually, guys, I contribute $125 to my portfolio every single week. Except for this week, I doubled down and contributed $250. And half of that went to buying AbbVie, and then the other half went into buying some Intel. So I think I picked up about 2.5 shares of Intel, and then I picked up just a little bit over a share of AbbVie. So this one's almost at 10 shares, which would be nice to get it there. And then we're slowly but surely making our way with Intel as well. So let's go over to this diversification page real quick, guys. So let me go over here, scroll over here so you guys can see. So this is my actual allocations, and these are my target allocations. So this is how my stocks are actually allocated in my portfolio, and this is where I want them to be, or the sectors, I mean, not the stocks. And as far as technology goes, Intel is the only one that I have in that sector. So I want to get it to that 3% mark, which means I'll probably have to just pick up a couple more shares next week, and then I can move on to the next company or the next investment. And then as I mentioned earlier in this video, guys, the next stock I'm adding to my portfolio is Lockheed Martin. So I've allocated about 3.25% in my industrials sector to build out a small position in Lockheed Martin. I'm just hoping that the share price continues to come down a little bit before I get into it, but even if it does start to creep back up, that's okay with me as well, because it is still looking pretty affordable in my eyes. So I wouldn't mind paying a little bit more for it next week than where it's currently at today. It's not a big deal. Anyway, guys, that pretty much wraps it up for today's video. And I think we covered a lot of good ground in this one. This one was a pretty long one. Anyway, I hope you guys enjoyed watching and got some good ideas of some stocks that might be good investments coming up. Let me know what you think about any of the stocks stocks we covered in the comments below. I would love to hear your guys' thoughts. And also, before you click on to the next video, please don't forget to leave a thumbs up on this video if you have not done so already. And if you enjoyed watching this, if you're still here with me at the end, I'll ask you one more time, please consider subscribing to my channel as well. There's a lot of great dividend stock videos coming your way, and I'd love to have you along for my dividend investing journey and keep you updated on what's going on in my portfolio and also hear more about yours. Anyway, with that said, guys, I will now get out of your hair, but thank you once again so much for watching this video. I really appreciate it. Hope you guys have a great day, and I will see you in the next one.